सेट से जाना है। Then yes, अच्छा है तुम्हारा नाम।
मैं देखना छोड़ दो इसको, उसने एडमिट करा प्रोसेस सर।
हाँ जाओ। स्टूडेंट को एडमिट कर।
ऊपर से सर, एकदम ऊपर से ना, ऊपर से एडमिट वाला ऑप्शंस।
ये ये सीताराम में किधर से आए हो क्या? अरे गिरू में क्या है? वो तो तुम्हारा ही वीडियो। तुमने बोला क्या हो क्या वर्दी ये कैसे करो वो कैसे कसरत का अकाउंट है सब क्या अकाउंट विशाल करके विशाल वो भी ऐसे ही बोलो ना जेडी खान जेडी खान सितंबर के कैसे सुना
यूट्यूब से ही भाई बोले करिए।
A very good afternoon to all of you. It's a pleasure to welcome all of you once again to a webinar to discuss some of the recent amendments in the GST regime. As you are aware, two major changes which we are going to discuss today pertain to an advisory relating to a new incremental change brought about in the GST and portal relating to the return filing system, where there is an interface called an invoice management system which has been proposed. The advisory, we have already sent it to you earlier, but we thought since this is a far-reaching amendment or a proposal, we should discuss that in a little bit of a more detail. And therefore, that is one of the facets of discussion today. And as we are aware, a couple of days back, that there was a GST Council meeting, and there are certain recommendations made by the GST Council meeting, and certain circulars also have been issued in that regard. Though some of them are very specific, we'll just quickly run through those amendments which have been proposed by the GST Council in their 54th meeting. So I am aware that this is a working day, afternoon time, so we'll try to keep it as brief as possible, and we'll try to wind up the session at the earliest possible time, maybe around 45 minutes to 50 minutes, followed by a few questions if there are any, and we would target to wind up before 4 p.m. today. So with that, let me just move into the invoice management system and the major incremental change which has been proposed. And essentially, life reaches a full circle. And as we will see, the way the amendment is being proposed, we are perhaps stepping back into the original thought process of the GST matching concept, which was being proposed in 2017, but through various workarounds which never got implemented. And I think the prelogue to this entire process is that while we say GST is a one nation, one tax, the fact remains that there are many stakeholders. In fact, we have center as a master stakeholder, and each of the state governments, and we have many of them, more than 30 state governments, each of them also is a stakeholder. And therefore, when we implemented GST, we said that we need to distinguish between the wash nature of the tax and the sink nature of the tax. And we've discussed that when GST was being implemented in extreme detail. So that's where we have these concepts called B2B and B2C, which we are using them regularly nowadays in return filings and implementation processes. We are aware that as far as B2C transactions are concerned, the GST collected on B2C transactions is an end tax because nobody is going to claim an input tax credit. The tax can be easily shared between the center and the destination state. And to answer that, who is the destination state, we have elaborate place of supply provisions. And even our GSTR1 filings requires the data of B2C to be uploaded on the place of supply wise basis. And therefore, as far as B2C supplies are concerned, there is no challenge. But when a vendor uploads a document as a B2B invoice, the entire possibility of claiming the credit arises. And that's where we look at the provisions of the input credit law, and we are told that generally input tax credit is expected to be seamless, and the concept of input tax credit is very wide. Despite that, there are situations where the credit is not eligible. The situation could be it's a block credit, it could be used for exempted supplies and various other situations. Therefore, whenever there is a B2B supply wherein there is a GST involved on the output side, the government does not really have a visibility of whether that B2B tax charged by the vendor is claimed by the customer as credit or whether it is blocked as a credit. It also may not have a visibility of whether it is going to be claimed today or maybe 6 months down the line or 4 months down the line, because the law itself provides for a certain timeline for claim of the credit. The invoice might be dated of April 24, but the credit could have been claimed in April 24, May, June, July, and so on and so forth, all the way up to the October of the next year. Therefore, essentially, the government finds a little bit of a confusion between the first and the second situation. The first situation where the B2B tax paid to the government is available as a credit, it stays in the asset of the buyer as an ITCGL, and therefore corresponding it's a liability of the government. It cannot be shared between the state and the center because it has to be repaid by way of input tax credit. But there can also be a situation of a B2B credit which is not eligible, and that not eligible block credits has to be shared between the center and the state. And essentially, because there is a little bit of a confusion due to this three compartmentalization of the taxes being charged, we saw a lot of challenge on that front. And thereafter, last year, there was an issuance of a circular which forced the taxpayers to claim all the credits which are appearing in your GSTR 2B, which is the auto-populated statement of vendor credits uploaded by them. And then they said that, okay, we understand that all these credits may not be eligible, initially eligible. It can be eligible, it can be not eligible, it can be eligible in the future. And therefore, through that circular, an advisory was given that you claim everything, and whatever is not eligible, you reverse it. If it is permanently not eligible, effect a permanent reversal. If it is temporarily not eligible and you are likely to be claim it in the future, show it as a temporary reversal. We are all implemented it, and we did a couple of webinars when this circular was implemented. And as of today, I understand most of our clients have already implemented that circular. So we are aware of these concepts of immediate claim of credit reflecting in GSTR 2B, along with the concepts of permanent and temporary reversals. So that's where we look at what is permanent and temporary reversal. And just a very quick recap of what all constitutes a permanent reversal. We generally say that any expenditure incurred by the organization is eligible for credits, so long as it is for the furtherance of business. Only a small list of items are not eligible, and that list of bullet points of items not eligible keeps on increasing. That's another topic for discussion. But yes, let's quickly summarize what all things are not eligible. So, items which are specifically blocked under section 17(5). We are aware that Mediclaim is not available, construction services are not available, rent-a-cab is not available. All those items which are block credit is an item of permanent reversal. Something which is not for the furtherance of business, something like your CSR expenditures, they are not for the furtherance of your business, not eligible. Your IPO expenses for the purposes of selling of shares, again, if it's a link to a securities and not to your core business, not eligible for claim of credit. Any input services or inputs which are used exclusively for providing an exempted supply is not eligible. If you have both taxable as well as exempted supplies, then for common expenditure, there's an apportionment of credit, rule 42, we are aware of about it. There are certain sectors like builders, real estate sector, restaurants, etc., where ITC is specifically denied through rate notifications. And of course, we are all aware of the miseries caused by Section 16(4) timelines and the amendment which has been proposed. So if you are claiming an ITC after the prescribed timelines, then those delayed ITC is also not eligible for credit. You can see that there is a star against one type of an ineligible credit, which is place of supply mismatch. So what has happened is ever since GST has been implemented, people have understood GST to be a ring-fenced tax, meaning if the place of supply is of Maharashtra and the credit is flowing in the state of Gujarat, Gujarat will not give you a credit. And that is what has been implemented by way of department authorities assessment in the course of assessment. And recently that has been implemented in the GSTR 2B document also, where if there is a place of supply mismatch. For example, if you are registered in the state of Maharashtra, but if the vendor raises an invoice with a place of supply of Gujarat or Karnataka, then it would disclose the credit as ineligible. So that is, of course, that's where the star is for the reason that while the portal implements this place of supply mismatch, practically from the legal perspective, we could not find any provision in the law which says that if there is a mismatch of a place of supply, credit is not available. So that's a separate debate in itself, and we have been defending some of the show cause notices on this point. So friends, these are items which will fit within the concept of permanent reversal. As far as temporary reversal is concerned, the eligibility of credit is very much there, but because some of the conditions are not satisfied today. For example, the vendor has raised an invoice, but you have not booked it in your system. So you do not have a valid tax invoice as of today. Maybe you'll get it maybe 6 months down the line or 1 month down the line. Sometimes the goods or services are in transit and you have not received the goods or services. Or sometimes the invoice is received, but the matching with 2B does not happen because the vendor has delayed his filing of returns. If vendor has not paid the tax again, then there is a situation of a reversal of a credit. We are aware about all the miseries caused on that account. And sometimes I might be paying the vendor late, and then there might be a requirement of a reversal after 180 days. So in all these cases are examples of temporary reversals where today you will reverse the credit. Having claimed it once, you will reverse the credit, and thereafter you will reclaim it as and when the situation gets regularized. We are aware of this broad thought process. And this is how we currently implement the entire process. This is the ideal case scenario. I am aware that in specific cases, there might be some small aberrations here or there. The process flow, as we are aware, is the vendor will raise an invoice and issue that invoice to the taxpayer. The taxpayer will account the invoice in its books. In the meantime, the vendor would have uploaded the invoice in his GSTR1, which flows into the taxpayer's GSTR2B. Immediately thereafter, at some point at the due date, vendor will also pay the taxes through his GSTR 3B, and that's where the vendor's cycle gets over. But the taxpayer's cycle actually starts once the GSTR 2B is downloaded on 14th, because that GSTR 2B will have the vendor's invoice details. He is then expected to match the downloaded GSTR 2B with his books. And we are aware of this matching process, the detailed matching process which happens. And based on the matching process, you have situations of transactions appearing in your 2B but not in books, appearing in books but not in 2B, and appearing in both the situations. And we are aware of the action points to be taken. And accordingly, based on the summary of the matching of course would happen at a transaction level, because 2B is a transaction level detail. Your ITC GL or your purchase register in books is also transaction level detail. So you will use a VLOOKUP or some system to do the matching. After the transaction level matching is done, you will aggregate it based on the scenarios of available in 2B but not in my books, available in books but not in 2B, and things like that. And based on that, you will, on an aggregate basis, you will impact the 3B. And this, I think, is the key point, that when you're looking at 3B, 3B is a summary document. And when you prepare that 3B, you will have to claim every credit which is appearing in 2B, and thereafter undertake the permanent and the temporary reversals as shown in the earlier slide. Naturally, when you are doing the temporary reversals, and you have also done temporary reversals in the past periods, there will be some items of past which get matched in the current period, and therefore you will have reclaim of earlier temporary reversals. Now, the government also wants to ensure that your reclaim cannot be more than your reversal. So if you have reversed 1 lakh rupees, you cannot reclaim more than 1,10,000. And therefore, as a side step of the GSTN portal, we already have a cumulative statement of reversal and reclaim available, where you will always be getting a closing balance of temporary reversals which have still not been reclaimed. But that again is a closing balance. It is not a line level detail. The line level detail would be available to you in your Excel sheets or in your systems, depending on where you are doing the matching and the other processes. Last month, we also have implemented a cumulative statement of RCM and corresponding input tax credit. Again, the whole idea is because we do not want organizations to misuse the system and claim credits which are more than the eligible amounts. Therefore, all these checks and balances are being brought in through some small processes in place. So while we have this current process in place, and if you look at the current process in place from the taxpayer's perspective, I think the situation of an ideal control point would be that as far as eligible match credit is concerned, the closing balance in your ITC GL of eligible match credit should match with your closing balance of the electronic credit ledger balance. As far as ineligible credits are concerned, they should become a part of your permanent reversals in the GSTR 3B, and also they should be written off in the books of accounts, either by way of addition to the expenditure or to the asset underlying asset. If there are transactions only in 2B and not in books, we already discussed that these are items which are a part of the temporary reversal, but only an aggregate cumulative balance is available on the portal. This data is also not available in your books, and that's the reason why this bullet point comes into place. And therefore, you will have to be very careful about maintaining a YTD record of all your transaction level details which add up to the cumulative balance available on the portal. This is important because in future, as and when the matching does happen, you would want to claim those credits. The third part is there are transactions in your books but not in 2B. In these situations, you can't claim the credit. We now have that section 16(2)AA very clearly saying that the credit is available only on the basis of matching. And therefore, in these cases, in your books, it will appear as a deferred credit. It will be a closing balance in books, but no reflection in the 2B. What it means basically is that you'll have to follow up with the vendor, force them to upload the matching happens. You will have to move the credits back from deferred credit to the normal GL and claim the credit. So this is, I think, the current process control points from a taxpayer's perspective. But from a GSTN perspective, the fundamental factor that the transaction level details are not available in the GSTN system results in a little bit of a lack of confidence of the government on the taxpayers. And that then starts creating a difficulty in terms. Am I audible? I think someone is commenting that my voice is not clear. Is my voice clear? Can somebody respond on the chat whether you are able to hear me? Okay. So I'll continue with the challenges in the current process. And as I was saying, because the transaction level details are not available, it results in an element of a lack of the confidence or the trust of the taxing authorities on the taxpayers. And if you look at the journey from 17 till date, you will find that this aspect of presumptive notices based on data differences is the order of the day. The government will therefore want to use AI, compare some information which is available to them. Again, those informations are available on an aggregate basis in some cases, especially for the ITC side, it's always available on an aggregate basis. And therefore, they would presume certain things, and based on that, they will issue notices either in ASMT 10 or in DRC 1A. Then you will have to run helter-skelter, explaining that this is not how it was, this is what was the situation. You'll have to attach your purchase register. At times, the officers would be inclined to undertake a detailed verification and be realistic and drop a substantial component of that demand. But in many cases, because of time pressures and other reasons, we find that the officers turn a blind eye to all the detailed submissions made by the taxpayer, and various erroneous and inflated demands are confirmed. Now, necessarily that requires a pre-deposit, and that's where I think the major challenge comes in. We are aware of various types of situations. You had credits available in 2A in year 1. Because of the timelines of section 16(4), and you are recording the transaction in the next year, you claim that credit in the next year. The department just compares the 2A for the next year, along with the 3B of the next year and then issues you a notice. And then you have to run helter-skelter explaining all these things. Same way, vendor has uploaded the tax under an HSN code relating to, let's say, construction service. And therefore, the department presumes that you have claimed the credit. Whereas you should not have claimed the credit because according to the department, it is block credit. But many a times they don't even verify whether you have actually claimed the credit or not because they do not have any transaction level details. So this is one major challenge which comes in the current process. Second challenge which comes in the current process is also from the fact that the circular which has been issued, forcing you to claim the credit appearing in 2B is technically contrary to the law. Because under the law, you cannot claim the credit before you receive an invoice. Now, here the situation why you are reversing the credit is that according to you, you have not received the invoice, it is not booked in your system. So in a way, you are committing an error or a legal illegality by claiming the credit. Now, after claiming the credit on the same day, you are also reversing and therefore it nullifies the situation. But the fundamental fact still remains that you are not allowed to claim the credit in the first place. And therefore, this circular is there's clearly an inherent conflict in it because it's a circular and you are implementing it. Nobody's going to ask you a question, but there are questions asked at an organizational level. Many a times, maybe an unknown stranger vendor who is not related to you in any way might by mistake upload a credit into your account instead of uploading it into somebody else's account. Now, you are forced to claim the credit. Does it mean that there's a deemed acceptance of the transaction? And these are questions which are floating around amongst the organizations. So that was one open-ended area in the current system. And the third open-ended area in the current process was there is no mechanism to verify whether the credit notes, the reversal of credits has been impacted by the buyer. And therefore, last GST Council meeting, they issued even a circular requiring that you should obtain a CA certificate or a self certificate from the buyer saying that they have reversed the corresponding input tax credit. And of course, that becomes messy. And that was not the objective of the GST system to go into too much of documents and physical papers and things like that. It was all expected to be a system generated thing. So these were the challenges which the governments were facing in the current process. And I think an ideal solution, which I'm also happy with to a large extent, is the proposed insertion of the invoice management system. So if you look at the current process, which we saw in this earlier slide, you find that in the new slide, which is the proposed process, there is one more step which has been introduced, which is the invoice management system. So the idea is, as and when the vendor uploads the data in GSTR1, the data of the invoices, documents, etc., will automatically flow immediately as the reflex action in the invoice management system. In this invoice management system, we are now given a two-way interactivity. Earlier, everything vendor used to do, and you are only going to do corrective action on an aggregate basis by way of temporary or permanent reversals. Now, you are actually given a control of each transaction level data in this invoice management system. And for each transaction of invoice, you can either choose and accept, reject, or pending. This was something which was envisaged in 2017. So if you are happy with the transaction, it's there in your books, you can accept the vendor invoice. You may later on check whether it is eligible, ineligible. So acceptance does not mean eligible, ineligible. It means that I accept the transaction with the vendor. Reject is you are saying that the transaction never happened with the vendor. I don't know this vendor. He has by mistake put it. The moment you put rejection, the transaction goes out of your system and an intimation goes to the vendor to take corrective action because naturally he has done some mistake by putting a wrong GST in these cases. And finally, there could be cases where the invoices could be in transit or various reasons you are also unsure. So you might want to keep it in abeyance. You want to keep that thing in invoice pending and you will take a decision in the future. So all pending invoices will be carried forward in the subsequent period. So what happens is because you are doing this accept, reject and pending, we are now told that whatever is accepted, only those filtered invoices, only those filtered records of accepted transactions in IMS will flow into GSTR2B. Now, it's important to understand the timeline because there is a very strict timeline for filing your GSTR 3B. And we are aware that all this process, IMS, GSTR 2B, etc., will be steps towards reaching your correct GSTR 3B, which is hard-coded for 20th of each month. We are also aware that all of this starts only once GSTR 1 is filed, and therefore the timelines are very limited. So what we are told is, moment the GSTR 1s are filed, the transactions will flow into your IMS. So on 12th also you can download an IMS. And once you do the accept reject pending, thereafter on 14th GSTR 2B will get generated. Now, what happens if you don't do this? The system right now we are told is optional. So you may not choose to do anything. You might just continue the way it is. In that case, the government will assume that all the transactions in IMS are to be accepted, and therefore there will be a deemed acceptance of all the transactions from IMS, and everything will flow into GSTR2B. So essentially, you are given an optional filter whereby you can have better records, organized records in your GSTR2B, and all your doubtful items, all your pending items can continue to be pending in IMS, and it may not mess with your 2B. And once it does not mess with your 2B, it does not mess with your 3B. Because if the pending item is not coming into 2B, you don't need to do a temporary or permanent reversal, and therefore your credit reconciliations, blockages, all those things become much easier. So in that sense, I think it's a very important and a nice filter which has been introduced. Now, some of you might ask me that, okay, 11th to 14th is one thing. 14th, people, the department will generate the GSTR 2B. What if 11th, 12th, 13th is holiday, and therefore my team is not able to action out on the IMS? So here also the government is saying that just like you can action out on an IMS, you can also action out on the GSTR 2B. You can download a 2B, and in that 2B also you can do an accept reject pending. And once you do that tagging of accept reject pending, thereafter submit it to the government portal and then regenerate the GSTR2B. And therefore, now a GSTR2B can be a recycled document, and it can keep on changing from 14th onwards till the time you finally say that, okay, this is the last iteration. You can do 2 iterations, 3 iterations, as many as you want. But at some point of time, you will have to freeze it and say that this is my final data. And based on this final data, I'm filing a 3B. The day you file a 3B, the GSTR2B becomes frozen. After that, you cannot do the change. But till that time, up to 19th or 20th, when you are filing a 3B, you can keep on making amendments to the GSTR2B data by way of accept, reject, or pending action points. So that is where this entire iteration which we are seeing here in the box somewhere here, where we are talking about accept, reject, pending, a two-way communication between the books and the IMS up to 14th, and thereafter between the books and the GSTR2B from 14th till the date of filing the GSTR 3B return is now opened up or permitted. And that, I think, is a good opportunity for all of us to take care of. So just to summarize what we have discussed, this system will be implemented from 1st of October on an optional basis, while the government is saying it's an optional basis. And if you don't do anything, it will be deemed to be accepted and you can continue life the way it is. In our belief, it is important that you try to implement it as much as possible, so that we avoid the problems of deemed acceptance. Now, what is the action which you can take? Action to be taken on invoices and debit notes. You can either accept it. If you accept the invoice or a debit note, it will move to GSTR 2B. And naturally, then you will say either permanent reversal or eligible. Because the moment you have taken an action of accept rather than pending, it means that the transaction is matching with your books. You have rejected it, intimation will be sent to the vendor, and as I told earlier, he can amend that invoice and give it to the correct GSTN person in the next cycle. So here in these types of situations, my 2B does not get messed up because of the errors of the vendor. And finally, we have pending, where the transaction gets carried forward to the next period, where again you can do an accept, reject, or pending, and accordingly you can keep on doing it till the timelines of the GSTR ITC claim are available. So for example, for financial year 24-25, you could do this up to October 25. Now, as far as invoice and debit note is concerned, these are the three options. As far as credit notes are concerned, we may note that pending option is not permitted for credit notes. You have to either accept it or reject it. And there's a reason why they are doing it. Because as we are aware, a credit note will result in an impact on the tax liability. In case of an invoice or a debit note, the impact is only in terms of input credit eligibility and timeline of it. But in case of a credit note, there is an impact on the tax positions of the vendor or yours. So if you accept a credit note, the transaction of the credit note will move to GST or 2B and your input tax credit will get reduced because credit note is a negative tax amount. So it will reduce your ITC eligibility to that extent. If you reject a credit note, the intimation will send to the vendor and it will automatically increase his output tax liability. Now, this is important to understand as a strategy that how are we going to deal with this? Will you be accepting or rejecting a credit note which is unmatched? Because pending option for unmatched credit notes is not allowed. And again, organizations may take specific call. If they accept it, you have a problem that it will reduce your ITC. And if you reject it, it will increase the output tax liability of the vendor. Naturally, you would want it to, but the ball to flow in the court of the vendor, and therefore you may want to reject it unless you want to check your books and see whether there was some error in your books. If there's an error at your end, you might accept it and then rectify your books also in that manner. So just to summarize this, while it is optional, we believe that we should implement it. Looking at the slides, it might look very complicated, but according to me, it's really not complicated because all of these activities you are anyways doing today, either in Excel or in some native system, some software or something of your own. Only thing is this data is right now not populated onto the government portal. Now, the invoice management system essentially gives you an opportunity to bring that information on the government portal and document it on a long-term basis. And I think that's an opportunity which we definitely should not miss. The question is whether I will have to go to the site and use a drop down to select accept, reject, or pending. I don't think that's how the law has been implemented or administered. We have seen from day one, we have been given JSONs and APIs. I'm sure closer to the date, we will have a JSON or an API. And most of the softwares which we are using, ASPs, GSPs, would also bring in their customized modules to permit an automatic flow of this invoice management system on a bulk transaction basis. So we need not worry too much about this process. Whatever we have been doing offline, maybe it now comes onto the GSTN portal. And let's look at this from a very positive angle in that sense. As far as the actions to be taken, I would believe that unless you are very sure that you want to reject an invoice, you can keep it pending. Because accept is clearly the transaction is matching. I think it's a no-brainer. You will accept it and move it to 2B and then decide eligible or ineligible. But if the matching is not happening and you are in doubt, keep it in pending and keep it in pending till the last available opportunity, which is October of the next year. Until that time, at that time, decide whether to reject or to accept it. So accordingly, maybe on a day-to-day, a monthly basis, it's either going to be accept or pending. At the end of the year, there will be one more action point, which is reject. As far as credit notes is concerned, you may either accept or reject, as I said, depending on your discipline and the vendor discipline. Maybe this will also immediately bring to light some challenges which are there in these types of reconciliation items, and it's better that they get resolved earlier rather than later. So at least there is no interest or other consequences of that account. So this was invoice management system, and depending on how it works, we can then discuss individually about the broad implementation steps therein. I'll quickly take you through the recommendations of the 54 GST Council meeting. There have been quite a few changes, so quite a few items they have differed also. I'm not going to touch upon those differed items. We are on a busy work day, so I'll not spend too much time on it. But whatever has been implemented and the clarifications we'll discuss. And those clarifications primarily are relating to the tax rate changes for goods. So we are told that as far as namkeens and other products are concerned, the rate is reduced from 18 to 12 with prospective effect. And they underline this word prospective effect because nowadays we are seeing many situations wherein we are giving a retrospective effect or regularizing the past on an as-is where-is basis. So as far as these namkeens are concerned, they are very clear. Past demands will be on 18. There is no as-is where-is basis. It's only moving forward that it is being reduced to 12. Same way, specified cancer drugs, the tax rate is reduced from 12 to 5. The air conditioning units for railways and car seats for motor cars and for vehicles and automobiles, there have always been a problem in terms of classification because under the customs tariff, there is an entry which says that parts, components, and accessories of vehicles will be classified under the HSN classification of vehicles itself, and therefore the tax rate changes. And there have been lots of disputes on this front. So in this situation, two specific clarifications are proposed. One is to say that the AC units used in the railways will not go under the railways category, but will fit under HSN 8415, which is the AC category, and will be liable for 28%. As far as car seats are concerned, they have said that it will fall under 9401 and will be currently it's taxed at 18, but moving forward, the proposal is to increase it to 28. Again, increase will be prospective. Now, this third point is a little bit tricky. There is a change for the buyers of metal scrap. So if you are buying metal scrap, typically construction companies would generate metal scrap and sell, but some organizations might be buying metal scrap for further processing, melting, or other activities. So if you are buying a metal scrap from an unregistered person, then there is a reverse charge mechanism being introduced. But if you are buying from a registered person, then also there is a new provision called TDS, which is being introduced, and 2% TDS will have to be deducted when you make the payments to the sellers as far as metal scrap is concerned. So this is one area. If you have some one-off transactions, please look at it and then decide. The pain of RCM continues. We move to services, and in services, we are told earlier we had RCM on residential renting by an unregistered person to a business entity. Now we are told we'll be registered person to a registered person. Generally, examples are low, but if you have situations of a commercial property which you have taken on rent, maybe an office or a shop or something, and the dealer is not registered because it's below 20 lakhs, you will have to end up paying tax under RCM on from your own pockets. The next one again brings to highlight the subtle differences in the classification entries. So we have a concept wherein, and this typically started with the entire discussion about taxation for helicopters which are used for pilgrims transported to Badri Kedar and those pilgrimage spots. So there was a debate of what should be the tax rate, and in that sense, we are now clarifying that if the helicopters are given on a per seat basis, so a helicopter might have a seating capacity of 4 or 5, and if each seat is individually sold as a ticket, in that case, we are told it's an activity of transportation by helicopters on seat basis, and the tax rate will be 5%. Again, here we have the past, which will be as is where is basis. So if somebody has already paid 18 in the past, then nothing will be refunded, that 18 will be taken. It is also clarified that this applies on a per seat basis transportation. If the entire helicopter is leased, then the tax rate continues to be 18%. Approved flying training courses, this there are DGCA approved flying training courses. This had been a debate in service tax and then GST also. Now again, we have a clarification to say that this will be exempted from payment of GST. This next one is coming from the recent newspaper report where a demand was raised on IIT Delhi for the GST on the grants. And that's where we are told that grants which are received for providing research activities by a government entity like an IIT or a research association, university, college, or other notified institution. And this they have taken cognizance based on the income tax law, section 35 talks about notified institutions. So if any of them receives a grant, whether it's a private or a government grant, it will be exempted. Past cases will be regularized again as is varies basis. Thereafter, there is a series of clarifications on composite supplies. I think these were understood, but well, at ground level, there were some doubts being raised by authorities, and therefore they have clarified, and all the clarifications are somewhat on similar lines. The first example is in the real estate sector, where typically there might be a value charged for a sale of an under construction unit, and then there is a floor rise. So the negotiation might be that, okay, the flat is sold at 20,000 rupees per square feet, plus there is a floor rise of 1,000. If you are going to the 10th floor, maybe 1,000 rupees extra or 10,000 rupees extra might be added. So this preferential location charges or the floor rise or garden facing flat and all those charges which are levied, department at times used to say that this should be not covered under construction service but be liable for 18%. So there the clarification says no, this PLC also is a part of a composite supply, and therefore it will be liable for the same tax rate as applicable to the sale of under construction unit. Similarly, in case of transport agencies, GTA, where reverse charge or forward charge is implemented, many GTAs while they issue a consignment note and transport the goods, they might also undertake intermediary storage, where loading, unloading, insurance, etc. So all these ancillary services provided by a GTA, we are told, becomes incidental to GTA and classification will continue to be GTA. Of course, if the services are not connected with transportation but a subsequent activity, and let's say many a times a logistics provider might be doing both transport and after transport he might be doing a storage, then there are two services. Transport will be under the GTA at 5%, storage would be under 18%. Thereafter, we are told electricity distribution companies might charge meter reading charges, duplicate charges, etc. So all those are additional ancillary services. Again, these services are incidental to electricity distribution and therefore would be exempted. So all these concepts typically are coming from the concept of Section 8, which says that a bundled supply should not be broken up and the principal supply taxation should be interpreted and ancillary services should be ignored. The taxation should be based only on the tax applicable on the principal supply. Interestingly, when it comes to affiliation services in the educational sector, we have a very interesting policy variation which we are looking at. If there is a board like a CBSE or an ICSE or a state board, which provides an affiliation activity to all the schools, we are told that the affiliation fee charged by those boards to the schools will be exempted prospectively. As far as past is concerned, it will be regularized on as is very basis. So past, you don't need to worry. Whatever has happened, but in future, it will be exempted. As far as affiliation services by universities to colleges is concerned, because in schools you have boards and schools, but when you look at higher education beyond for graduation, etc., you have universities and colleges. But here we are told it will be taxable and there's no exemption, past, present, anything. And therefore, there was this controversy and various universities were received notices. They will now have to face the heat because of this clarification. A few small changes. Amnesty scheme was announced in the past GST Council meeting, and the amendment which was brought about in the CGST Act, Section 128A, we are aware about. We are now told that that section will be operational with effect from 1st of November 2024. Therefore, that will be the start date for amnesty. The amnesty scheme will continue till 31st of March 2025. And we will get detailed rules and circulars. And definitely, I would urge each of you to review all your pending litigations, and based on the detailed rules and circulars, we will advise you on whether you should go for amnesty or continue with the litigation. As far as ITC timelines for the past period, Section 16(4) amendment are concerned, here the press release says that the relaxation timeline will be notified at the earliest, and as a relief, we are told that wherever orders were already issued, a special procedure for rectification of those orders will be prescribed. And again, a detailed circular will be issued. So I think we'll have to wait, but just because there's some reference in the circular, in the press release, we are talking about it. But we will get details about this a bit later. And then maybe this would be a topic for discussion in one of the subsequent webinars also in detail as and when the circulars come out. We are also now bringing to rest a major controversy which existed vis-a-vis Rule 9610 and Rules 89(4)A, 4B. We are aware that somewhere the government was feeling that in certain cases, taxpayers were taking double benefits by way of not paying taxes on inputs as well as claiming refunds on outputs. And that perception was coming in situations where you are buying on advance authorizations or merchant export purchases like 10.1%. And then you are told that you can't do a rebate. And again, there was retrospective amendments to rules which were brought in. Now we are told, at least moving forward, these rules will get deleted. So prospectively, these conditions will no longer apply. And for the past period, we are told that, yes, there was an explanation which was inserted to say that if in advance authorization, you are claiming only basic custom duty exemption, but not claiming an IGST exemption, then the rebate can be claimed. Now we are told that if you had originally claimed the exemption both for BCD and IGST, and thereafter you have foregone the IGST exemption and reassessed the bill of entry, that also will be a sufficient compliance to Rule 9610, and therefore those demands can be regularized based on that type of amendment to the rules which and clarifications which are being proposed. A new concept which we are now thinking to bring about is B2C e-invoicing. B2B e-invoicing, we are aware, is now stabilized, and everybody having a turnover of about 5 crores in any of the past financial years is liable for B2B e-invoicing. We are now planning to bring B2C e-invoicing on a trial basis. Again, this is more like a policy statement than a detailed discussion. So we'll wait for a detailed regulation and then we can take it ahead. 3 circulars have been issued. The first circular deals with the eligibility for exports in case of advertisement agencies. We are aware that advertisement agencies can act on a P2P or a P2A basis. A long circular, the sum and substance is if the advertising agency is acting on a principal to principal basis, meaning he is procuring an advertisement as a purchase invoice from the media, and then he is issuing a sale invoice, his own sale invoice to a foreign client, then the transaction does not constitute an intermediary and is eligible as exports. But if the media house is directly invoicing to the foreign client and the ad agency is only eligible for a commission, then naturally that commission is a consideration for an intermediary services rendered, and that would not be exempted, it would be taxable. As it is, that service in most of the situations would be rendered to a media house. Even if it is rendered to a foreign client, because of the specific place of supply provisions, it would become taxable. As far as data hosting services provided by Indian companies to foreign clients is concerned, again, a detailed analysis has been done and we will be told that it will be eligible as exports. I think they are the correct interpretations, but because they are very specific, I am not going into detailed analysis of those circulars. But the end result is that they are saying that these transactions constitute as eligible exports. A favorable clarification is been issued in context of input tax credit on demo vehicles purchased by an authorized service station of motor cars. And as we are aware, generally motor cars are a part of a blocked credit unless they are used for further supply of the same vehicle. So therefore, their trading stock authorized service station are eligible to claim the credit. For their own self-consumption, they are not eligible to claim the credit. But when it comes to demo vehicles, the question was whether it is more like self-use or whether it is for further supply. And that's where the circular clarifies that such demo vehicles can be treated as eligible for claim of input tax credit, as they are used for ensuring further supply of similar vehicles, because ultimately the demo vehicle will be used by a prospective buyer to check the features of the vehicle, and based on that he might ultimately decide to buy some other vehicle of the same brand or the same make, similar vehicle. Therefore, they have said it will be eligible as credit. They have also cautioned that, okay, you might buy a demo vehicle, but if you're not going to use it for customer testing and customer test drives, but you are going to use it for self-use, like employee transportation, pick up and drop, etc., then you are not eligible. And the circular also clarifies that the ITC on demo vehicles does not depend on whether you are capitalizing it in your books of accounts or whether you are treating it as inventory or trading stock. Uh, of course, they have caveated it out to say that if you capitalize it, you can still claim ITC, but you will not claim depreciation on the ITC component. I think that's very clear. Even the Income Tax Act has a similar safeguard. So when we look at those types of safeguards, and accordingly, one will claim or claim the credits in that manner. So I think these are some of the major changes which have been proposed. And invoice management system, of course, is something which is very specific and useful. So I thought we will talk about it and have a meeting with you to discuss all of those things. Maybe we can have a couple of questions from the participants. You may like to put it in the chat box, and then I may deal with them one by one. We already have one question. The question is that can we reject the deemed accepted transactions appearing to be in a future date? So once you have deemed accepted a transaction and it appears in your 2B, you can reject it till the time you have filed that 3B. So to give you an example, if for the month of October, you download a 2B on 14th and all the transactions which flew into IMS for October have gone into 2B. But you have still not filed the 3B. In that case, you can reject the deemed accepted transactions and regenerate a 2B. But once based on a 2B, you have prepared your 3B, filed your taxes, paid your taxes and filed your returns on 28th. Thereafter, you cannot do anything about it. Then it's a closed matter. Then it becomes a frozen document. So I think that answers the question. There's a question which says if we do action in GST or 2B and we reject the invoice, it will go to IMS or vendor. If you reject the invoice in 2B, it will go back to the vendor. If you want it to go back to IMS, you will have to change it to pending. So pending is in IMS, reject is back to the vendor, accept is finalized in 2B. That this is the acronym which we will keep in mind. We will share the PDF at a later point of time on WhatsApp and the mailing lists. Do we have more questions? Okay, I think we are done with the questions. Thank you very much for joining at a short notice. And you can reach out to your relationship managers or partners for any specific queries that you might have. Thank you.